We continue with our discussion on financial modeling for valuation of companies and linkages of financial statements of companies. In our previous section, we have already incorporated a fully linked model for a company. Now, we're going to extend this analysis in terms of trying to understand what happens if future debt requirements of a company change. We have not yet modeled those, right? Now, this company at this point of time has a very little debt that they carry on their books. On their balance sheet, they have very little amount of debt, and their debt equity ratio is negligible. It's close to zero practically, right? We had, if you remember, projected future debt requirements, assuming a certain capex, and based on the capex, we had said a certain debt equity ratio, right? Now, what we could choose to do is make this entire analysis a little bit more dynamic, right? So the first things first, we can bring in the installed capacity assumption here on this particular sheet. So what do? We basically color these cells so that we know what is the installed capacity, right? Let's say Maruti is going to take its capacity from 1.5 million or 15 lakhs to something like 2 lakhs increase every year for the next 3 years, right? Let's say that is the broader assumption, that in the years which are given, we are looking at an increase of 2 lakhs every year, right? Based on this, if we look at the capex schedule, all we need to do is basically drag this entire cell all the way up to 2018, because that's already linked to the assumption sheet. We can get this calculation here, right? Our broader assumption is what is going to be the gross capex or capital expenditure needed per car capacity, right? Based on which the formula is already in place. So let's say we say this number should be about 1.5 lakhs. We get a total capex number, and I can say that this number stays at 1.5 lakhs and this number stays at 1.5 lakhs. So from whatever data we already have, where we are saying 33% of this number is going to come in the form of debt and rest of it from the internal accruals of the company, which is effectively equity, because those cash flows otherwise will go to the equity holders, we can basically extend this analysis as well, right? When you go and look at the cash flow, you will see that capex has become 3,000 crore here, and changes to debt coming in has become 990 in this case, right? Now what we can do is, instead of putting the assumption here, assuming a 1:2 debt equity, we can say target debt equity for capex. Right now, the company could choose to say that I'm going to choose 50% or 0.5, right? And let's convert this to decimal. So I'm going to use 0.5 as debt, or I'm going to use 1 as debt. So this is debt equity, remember, right? So when you say debt equity is 1, that means D by E is 1. When you say D by E is 1, that basically means equal amounts of debt and equal amounts of equity, right? That's what it means. So effectively, when we say this is 1, then equity is also 1, which means half and half, right? In other words, when we say target debt equity for capex, we have to find out what is the debt to capital ratio, right? We have to find out what is the debt to capital ratio. And we can also project that separately. So what is the target debt to capital for capex? And I can actually take an assumption on this, that how much of the total capex has to be funded using debt in this, right? So, or percentage, I can just change this to percentage debt funding for capex, right? Now we can change this depending on the year. I'll just remove this line. We can change this depending on the year. We can in certain years assume 50%, certain years assume 80%, certain years assume 20%. These are assumptions. So I'll mark them yellow. Why are these assumptions different? Is because the company might choose to have different debt fundings in different years. In which case, what happens is my capital expenditure gets multiplied by whatever is the percentage debt funding, and that becomes my debt. And I can extend this here, correct? And so now we figure out that the percentage of debt being taken is significantly higher. So you'll obviously see that your cash flows increase by the amount of debt taken, right? And consequently, there has to be one more change. Remember, we had assumed for this particular company that interest cost remains fixed. But interest cost remains fixed only if debt remains constant or debt remains negligible. That is no longer the case once we start incorporating bigger debt numbers. Right? Once we start incorporating bigger debt numbers, then interest cost may not remain constant. And hence, where you are doing the capex schedule, either you could create another schedule called debt schedule or just rename this as capex and debt schedule. Right? So we can rename this as capex and debt schedule, and we can say interest cost calculations. And for this, we will get long-term debt here and we will get short-term debt here. Remember, you're going to pay interest on both long-term and short-term debt, right? So I can go to the balance sheet, and for which years are we looking at? FY11 onwards. So I can link the long-term debt of FY11 here, long-term borrowings. I can link the short-term borrowings from here, right? So those are the total borrowings I'm getting. And remember, these are year-end numbers. It's possible that during the year the company had bigger interest numbers. So how do I know what is the interest cost? What I will also do is I will bring in the interest calculation from the profit and loss, which is the finance cost, right? I can bring in the interest here, correct? Now we need to identify and try and find out if it makes sense to figure out what is the interest cost for the company. Right now, how do I find the interest cost? That's my interest divided by my total long-term plus short-term debt. In general, that's the kind of cost I'm going to see, right? Now we will find this number will be all over the place. And why is this number all over the place? Is because these numbers are from the balance sheet, and the long-term debt number and the short-term debt number are year-end numbers. While this number is from the P&L, this is an annual number. This is an annual number, right? What does that mean? This is for 1 year, whereas these numbers are exactly on 31st March of that year. It is possible that in January of that year, the company had a much bigger debt. But when you recorded the balance sheet on the last day, the company had repaid the debt by then, right? So if the company had, let's say, 4,000 crore of debt for the entire year, but on the last day they repaid all of the debt, this number will appear odd because the interest is calculated on the entire debt during the year, correct? And that will cause this interest cost to get distorted from time to time. You will generally note that for a company the stature of Maruti, the interest cost would probably be 8 to 10% in the future. So let's assume that in the future this number would be 10%. I can continue calculating these numbers because they've already been calculated from the debt balance sheet, and in the balance sheet obviously we will need to project these numbers further to get this data and also project these numbers further, right? So if you look at the capex and debt schedule, you will get the numbers here. I can now calculate my interest cost as 10% multiplied by long-term debt plus short-term debt, which is my total debt. So for this particular year, my interest cost will be 244 crore, And my profit and loss account in FY16, rather than looking at the number of the previous year, should start linking the number for this year. And that gives me the 244 number, correct? All I need to do now is basically extend this entire analysis for subsequent years. So I can just assume that in the coming years also these numbers will be 10%, and I can drag it further and I get my interest cost for subsequent years, right? With the exception of the capex and debt schedule, we have not really projected anything else for the next 2 years, but all our formulae are in place. So if I want, I can just do a simple calculation. I just need to do a copy and paste because all my formulae are in place, right? Because all my formulae are in place, I will automatically get the numbers on the assumption sheet. I can copy everything on my P&L sheet, copy everything on the P&L sheet, and paste the number in the next years, and we will get these numbers as well. And we can copy everything on our balance sheet and just drag these in the future, right? So we can just continuously take everything that we see here and just drag them in the future, right? Take everything that's there and just drag them in the future, right? Now, ideally, if the model is linked correctly, then when we drag the cash flow, right now you'll see the model will not match. But ideally, if the model is built correctly, when you drag the cash flow, your cash number should take care of everything else, right? So if I drag this for 2 years, it should take care of my overall numbers, right? So what did we do? We just copied and pasted all our calculations for subsequent years, and we should now see possibly that our balance sheet should balance. So if we have linked everything correctly in the model, if everything is clearly linked, correctly linked, and we have just dragged these formulae ahead, we have now incorporated how much capex is happening every year, what are the changes to debt each year, what are the cash flows for each year. Every year closing cash balance is the opening cash balance of the next year, and the sum of these two gives me the closing cash balance. This number goes and sits in the balance sheet in the form of the cash number, and because this number sits as the cash number, we find that the balance sheet starts getting balanced for subsequent years as well. Now this is a completely dynamic model where we have also incorporated future financing needs based on percentage debt funding that we want, what kind of interest component we build in, which brings in the interest component to the P&L, reduces the profitability by that account. So if tomorrow the company decides to do 100% debt funding, note the profit and loss: 3978, 42, 3900, 4200, 4600, right? Let's increase the funding to 100% debt each of the years. The moment it changes to 100% debt, you will see interest cost will shoot up. Because interest cost will shoot up, your profitability will start declining, right? Because your interest cost keeps shooting up each of the years, right? And based on that, your cash flow numbers will start changing. Your cash flow numbers end up going up despite your profitability going down, is because the debt has come on the books. On the balance sheet, under long-term debt, you will see significantly higher borrowings at the end of the third year. We are now sitting with 9,000 crore. On the other hand, if I were to just reduce this to 0%, let's say we reduce this to 0%, and let's look at the cash flows, right? So no new debt, the company makes a certain amount of profit, but just barely manages the cash, and because of that ends with about 12,000 crore of cash in the final year, and that appears here as 12,000 crore. The balance sheet stays balanced. If the company was not generating enough profits, if the company's selling price, for example, on the assumption sheet goes down, let's say we were assuming a certain increase in selling price, instead of 1 plus 1%, if I was to do 1 minus 5%, and I was to replicate this across, we will realize the company might not make as much money. The company might start making losses by the time it reaches the final year. If it starts making losses by the time it reaches the final year, you will note that the company cannot survive based on its accruals. If it has to do this capex, then in the third year, the company will need debt, because otherwise you will end with negative cash balance. That doesn't work. So on the capex and debt schedule, you will have to assume that in the third year, at least 50% of debt funding has to happen. Even that doesn't suffice because interest cost goes up. So you will need at least about 70% debt funding, and that will bring your cash flow to cash positive numbers, right? So once you have linked the model correctly, dynamically changing the numbers and evaluating what is happening to your cash position. Remember, your bank account can never be negative. If your bank account is negative, that means the firm needs to borrow debt, right? So effectively, that's what we have established. We will go back to our earlier assumptions. So I'll add 1 plus 1% and copy and paste these numbers here. And once we do that, we again go back to our historical numbers. We can assume that the company is going to take 50% debt for all the three. And based on that, the cash flows get projected for the next 3 years. That is basically projection of debt or debt funding in subsequent years. That is how we will incorporate debt funding in a model, right? So that's broadly it in the context of debt funding. Note that the cash flow for the year is also nothing but your free cash flow to equity. So you can practically just discount this at a certain discount rate and arrive at what is going to be the value of this particular company, right? That essentially is how you would model for debt or dynamic debt or debt requirements in the future for any given company. Thank you.